Hey, good morning, everyone. Marty Missouri here, October 10th, 2021. So last week I did just a really quick technical update for you, and I thought I'd update that this morning and look to those patterns that we pointed out and see how they've played out over the last week. I want to zoom out a bit and take a longer term snapshot of the weekly and monthly indicators and throw in, one or two more for you just to get a flavor for how the technicals look currently. So in front of you is the chart we worked on last week. That was October 5th was the day I shot that video. And I was pointing to the breakdown below this rising wedge, below that bottom trend line, below the 50-day moving average. Several days of not being able to recapture that as being bearish. The negative divergences in these momentum indicators, right? So you have higher highs, but you have lower highs here. Sell signal here on the MACD, but I did point out that it was improving, that the short-term sell signal, this histogram was showing us that the MACD line and the signal line are coming together, and that was somewhat bullish. And then we had a little bit of a bullish divergence here in the RSI. So those were short-term bullish indicators, and maybe signaling that, a nice little rally was coming. Then we took a look at the 2-hour chart, and I pointed to these falling wedge patterns, which are very bullish. Again, the opposite of the rising wedge. And then these very distinct bullish divergences in the momentum indicators. That's a bullish setup, as I suggested last time. And we also zeroed in on the 1-hour chart. And essentially you had the same look there as well. You had the, again, the falling wedge. Very nice bullish divergence here. It's here with a pretty strong short-term buy signal on the 1-hour chart. Okay, again, bullish divergence on the RSI. Okay, so now we'll fast forward to current, and sure enough, that's how things played out. Again, here's that 1-hour chart starting there. So we had, again, one more time, falling wedge, bullish divergences, and so forth. And sure enough, that played out pretty nicely. So if you were trading this thing short term and you bought that there, you got a pretty nice pop. Now, since then, look what's happening. So now we're starting to roll over a bit. And here, at least on the hourly chart, right, very short-term stuff, we've got a short-term sell signal. And that reflects that rally petering out this last Friday. So again, we'll see how this plays out. There was interesting developments between China and the U.S. in terms of trade talks over the weekend. There's some good and bad there, and other areas that have to do with China, have to do with the U.S. and China as well, Taiwan and so forth. So we're looking for a catalyst. I think the biggest one was, the somewhat more cooperative sounding tone in Washington on the debt ceiling and so forth. They pushed that back to December. Market like that. But again, the technicals were suggesting that we were going to see something break out of that. And as I said, these things don't always work. We could have easily, just found resistance at like that 43.65 area that I talked about. But again, pretty good move, 30 points or so on the S&P from our last technical update a few days ago. And here's that 2-hour chart. So we're still on a buy signal here, but you can see that's looking to roll over. So that bullish setup definitely played out on a short-term basis, and now you can see the market rolling back over. And then on the daily chart, again, remember the sell signal, and I said this histogram was showing us something different. Sure enough, right here, I've got it kind of in the way with my yellow line. We're just crossing over the signal line, so that's a short-term buy signal beginning. Our bullish divergence is still intact. Didn't quite catch or recapture the 50-day moving average yet. The S&P closed Friday at 43.91, 34. The moving average is at 44.03. Really important here that we break through, for the bulls anyway, break back through that 50-day moving average and then recapture the trend line. Right now, it's very ambiguous in terms of what to expect. Not quite the bullish setup, other than on the daily chart. This is getting more bullish, of course. On the shorter term charts, it's less bullish than it was a week ago. And again, these things can turn on a dime. There's a lot of headline upside and downside risk in this market, I think, currently. And as for the weekly and monthly charts, this time I'm going to pull from my weekly spreadsheet where I do my technical analysis and I copy and paste my charts onto a spreadsheet. And I thought I'd just pull from there because that one I'm giving you a 30-year look at the S&P 500 And this is with those momentum indicators to just kind of get a feel for what it's looked like longer term. And so as you can see back here before the tech bubble burst, right? You had your rising wedge pattern, and you had your real breakdowns here in the momentum indicators before we had that really rough 30-month period. And then right here before the the real estate mortgage bubble burst, really rough period. You had all these indicators. Right in here, 2011, we had almost a 20% correction. Had some breakdowns here as well. Certainly had your rising wedge pattern. We had a 10% correction back here in 2010. We had about a 16% decline during this tough 2015-16 period. We had a flattening market, but we had bearish divergences here. You could make some more. You could do some more of this probably up in here as well. And then we had we had this rising pattern here. Right before the whatever you want to call it, the COVID recession. Had longer divergences here in the RSI, but not so much here in the MACD. You could argue that you weren't getting that signal before this one here. Now clearly though, we are getting stark divergences on the weekly chart. So this is something that looks more pernicious relative to how the setup looks in history. And what I like to say to clients in particular is that I don't know that this is going to play out, right, like this did and like this did. Don't know that at all. In fact, I've offered up somewhat of a bullish narrative as well that says that probably isn't going to happen. But I can tell you this, the next time it does happen, very good odds that this is what the setup looks like right before it does. So what does this do for us? It just kind of signals to us when we should be thinking about the odds of something consequential from a long-term return standpoint that we're going to want to diversify away from, hedge against, if you will. And this looks like one of those times, technically speaking. And then again on the monthly chart, right, slower moving, these are monthly candles. We do have a rising wedge, but we're still in a buy signal. Showed you this last time. Not much has changed, but you do see momentum waning in here, right? And you do have a very negative divergence here on the RSI. Another indicator we developed and have looked at over the years is this weekly moving average trend indicator. What we've done here is we've taken the 20, 30, 40, 50, and 60-week moving averages and lined them all up. And again, this is for the S&P 500. And then our PWA index scores along the way. Of course, this is all on a back-tested basis. We developed that index back in 2017. And so you notice back in here where the fast or short-term moving averages were still on top. That's what bulls want to see, is the fast moving averages, the shorter term on top, the slower, the longer term on the bottom. We had that set up, somewhat wavering, but we had a PW index that had notably rolled over. Right, time to hedge, right before, or a few months before, the real estate mortgage bubble blew up. Again, this was okay, but the fundamentals were saying recession risk is high, and sure enough, this is what happened. Prior to the COVID disaster, now again, we weren't predicting a pandemic, if you will, but our index was saying get defensive. And now we're sitting at what looks like a pretty bullish setup. You've got the fast moving indicators on top. You got a nice, up 20 in our PWA macro index. So that's why I keep saying, we don't have the kind of setup that tells us that we have a big protracted bear market risk there. But we have a very unique setup in terms of what's under the surface, how we got here, the toppiness of just a plethora of market indicators that we track. So even though this is not necessarily the kind of score and setup that would have us hedging, we're going to go ahead and continue to hedge here nevertheless while this unusual setup plays itself out. And then lastly, we have our Bollinger Band. So we track this weekly using the monthly chart. So this would be the monthly Bollinger Band. This gray line here is the 20-month moving average of the price. The purple is 2 standard deviations above, 2 standard deviations below. You can call this, an overbought, oversold indicator, if you will. So the S&P has been hugging that upper Bollinger Band for quite some time on a monthly basis. Each bar here is a month, right? Just now coming off of that, okay? And so when we look back and we can see long periods like this, of just really close to overbought on a monthly basis, right? Coming off of that, you tend to get, some corrective action. Here's that 16% hit in 2015 and 16. Here we were hugging it pretty good, came off of it a bit, recaptured it, and then that, that 19.8% decline in fourth quarter 2018. Then of course what happened here. We were hugging it, and then boom, came off of that. Leading up to the big one here in 2008. Just a long stretch of just bouncing off of that, then coming off of that strong. Where you take it very seriously is where you pierce the 20-month moving average and it begins to roll over. Slow moving indicator. But right in here, we're in 2008 when we came down, 2007, 2008, came down below it and then lost it here. That was the beginning of the end for the market there. Here in the late 90s, you can see just hugged it right up here, came down, tested the 20-day, beaten up against it, finally rolled over, 50% decline for the S&P, 85-ish% decline for the NASDAQ. Long ways from that here. But I just wanted to point out that we are finally coming down off of that and losing some momentum. And know, folks, that there's a tremendous amount of gains that have been captured against what I still see as a pretty precarious, very government-supported setup that really explains this, frankly, and that's the government support. We come off of that a little bit. We come off of the monetary support, which is clearly what we're looking at, and it's happening in many parts of the world. If the fiscal support doesn't pick up in a big way, we have a situation where the central banks are beginning to tighten policy against what economically, as I pointed out yesterday, is a slowing growth. Looks like a mid-cycle kind of scenario. So Fed tightening because of inflation, right, against slowing economic conditions, makes for a kind of precarious setup for the market. Now, all that said, we get a big spending package passed, we get the infrastructure bill passed, and we don't see massive tax hikes along with that. I think this market probably is going to continue its upward trajectory. And then we'll be having serious discussions about midterm elections coming up. But we also have earnings to contend with. And as I also mentioned this last week, we've been having a lot of discussions about, what's this going to look like when companies have to confess that their input costs are off the charts, and that's doing a real number on bottom line. So lots to think about out there, folks. Again, I'll sum it up again like this, though. We do not have huge recessionary risk that we can identify at this point. But we do realize those non-recessionary conditions are largely due to top-down support from government and central banks. And I've mentioned a couple of times on the written blog, the concept of reflexivity. And that's the notion that essentially market actors, consumers, and so forth, by themselves, you could take a situation that's not recessionary and turn it very quickly if, in mass, they react to, say, a market event and begin to pull in and hold on to their savings and not spend any money and so forth. So in theory, a market event coming from a very toppy setup, Harry Krishnan's excellent new book, Market Tremors, he explores the concept of dominant agents within the market, whether it's central banks or big levered ETFs and options dealers and so forth. There are big levered players underneath this market. And if the market takes too much of a hit and it triggers some of that leverage that has to be unwound, you could have a market event there. And that market event could do such a number on psychology that, suddenly we have recessionary conditions. Suffice to say, our job ain't easy these days. It's very interesting, very stimulating for sure. And boy, are we taking it seriously, despite the fact that the market, just kind of continues to melt up. To think that people should just buy into that, I think, is the wrong thinking. The risk of something negative playing out is higher here than you'd normally suspect, given our overall macro assessment. I will leave it there. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.